So welcome back everyone after some turmoil and then facing some hardships because of the pandemic. It's also an experience. We have to overcome these obstacles as we progress in our lives. Thank you for being kind enough to come back and then join our sessions. So today we begin the third semester, and the third semester thereafter fourth semester. And now I hear the good news that the government, health authorities are authorizing the higher education institutions to have physical classes as well as physical examinations in wherever they need to. So Institute of Bankers having a very unique location, it shouldn't be a problem for us to progress with this course. But of course, for the as per the classes, we'll continue online because it's my humble opinion that you are able to assimilate a lot of things virtually than meeting, traveling to the classroom at the Institute of Bankers and listening to, and then going back home. And then, in my opinion, the material that I prepare includes more content than when we met at the institute. So we are all lucky enough to share more factual content when we discuss things on virtual meetings, and saying that we have to move forward with our lives with the modern equipment and changes in lives. The modern telecommunication helps us to keep in touch, and then less congestion on the roads, and then we can share more content of the syllabus on a virtual basis. Only thing, we should have that will and necessity and the urge to share and assimilate more knowledge. So that helps us going to the next level of economic development in our respective industries. So a little bit of logistical news. Now we thought of having the class from 4 to 6. Now earlier we had the classes from 5 to 6:30, 1.5 hours. Now we are going to make it 2 hours in order to accelerate our program as well. But on my personal news a little bit is that tomorrow I will not be able to discuss with you because I have some personal engagement with regard to my demise of one of my relatives. The 7th day Bana ceremony is scheduled for tomorrow. So therefore I had to participate in that. So except for tomorrow, we'll have it recommence on Thursday again, today, Thursday. And then if you all are willing, if anyone not having any problem, we can also have it on Friday if necessary. But we have no time constraint. So what I discussed with Mr. Chandigalenage and then also with the institute is that we'll avoid tomorrow, but have the classes today and day after, Thursday. And then we can continue from next week, Tuesday, Wednesday, Thursday, if that is all right with you all. So that is the only announcement I have to make. But on the information of the course, you all have done very well on the examination and then the assignments. You did 2 assignments, right? So 2 assignments, so everybody is satisfactory. We'll see. I was not given the marks on the examination so far by the institute. we can help anyone who had not fared, if there's anybody, any single person who had not fared well in the examination, along with Nipuni from the Picket Chapman, we can ask them to resit the examination and then get them through if there is anyone. So let's work like this, and then our attitude should be very positive to gather and assimilate more knowledge. So today's topic is Treasury Management Overview. This is the beginning of the third semester. Familiar pictures, isn't it? Talking over the telephone. This is all about the treasury management in financial institutions. So you all have been very familiar with this type of pictures and then day-to-day activities. So in this lesson, what we are going to learn is the overview of treasury management, how the transactions are booked in, executed, more specifically the controls or internal controls, and then also particular risks that faced by the treasury personnel and the institutions in this treasury management arena. Then we will see how those risks are mitigated to improve the performance of each and every individual plus the institutions in our economy. Okay, I think this particular slide may not be in what the slideshow that I shared with the institute. So if anyone requires, please take notes of particularly this slide. So it can be very helpful in understanding, and then as well as in the preparation to the examinations. And then also I will share with you a topic for an assignment in due course for the third semester. If anyone has an idea of any probable assignment topic for the assignment, please share with me so that we can discuss and then arrange a particular suitable, appropriate topic for the written assignment for third semester. All right. So this is the introduction to the treasury management. Basically, savings. What are savings? Income minus expenses equal savings. Anybody's. Your salary, and you have expenses for food, traveling, and other household expenses. The balance is savings. So when you take the economy at large, the entire economy, the individuals, family units, small businesses, enterprises, corporate companies, even the government, large corporates and the government, all have these features of the income minus expenses equal savings. And then most of them, almost all of them, they receive the income to the banks or the financial institution that they have opened account with, except for the extremely low level of workforce who may not thought of even or walked into a bank in their lifetime. But our task is in the society to get everyone to use the benefits of the banking system use of the financial institutions, use of plastic cards, and then economize their income and then expenses and improve their savings. That should be the aim, which is in one word called financial inclusion. Please take note of that. Financial inclusion meaning those who have been not taking part in the money flows through the intermediaries like licensed commercial bank, licensed specialized bank, and the registered finance companies, primary dealers, stockbrokers, and various other institutions in the economy who deliver the financial services to the public. They must be educated. The knowledge of financial literacy must be improved, enhanced to take advantage of these so-called institutional arrangements in the economy, financial intermediaries like licensed commercial bank, licensed specialist bank, registered finance companies, and so on and so forth. That helps the money supply and pool of funds in the economy to flow accurately, and then multiply the usage of the income that they generate, not only to the individual concerned or the company concerned, entity concerned, but the entire society and the economy at large. Remember those days without banking practices, people used to hoard money in the Almira or Petagama in their houses in the form of notes and currency notes and the coins, which is detrimental to the smooth flow of money in the economy. And I can remember very well, sometimes you may have not been, you're not born in that era, where Dr. N.M. Pereira as the finance minister, I think somewhere in 1980s, finance minister, not 80s or 70s, I think, 1970s. Those days, the largest value of currency note in circulation was 100 rupees. He took a surprise decision to cancel all the 100 rupee notes in circulation and issued a new note. Basically, the old notes, 100 rupees in circulation in the hands of the public, was made illegal. Just mere piece of paper. And then he took steps to issue new 100 rupee notes just to pull out the hoarded money, large sums of money kept at home in the Almiras and Petagamas to the money circulation in the economy. And then he left only about, if I can remember correctly, about 2 or 3 months period only for those who held the old currency note, 100 rupees, to be exchanged for new currency note, 100 rupees, at any bank. At any bank and finance company, he gave a short time limit for everybody to exchange the old cancelled currency note to the new currency note. So that way, financial inclusion was promoted even in that era by Dr. N. Pereira, who was the Minister of Finance at that time. So that proved positive results, and the banking sector deposits also was enhanced. So what I'm trying to stress here is that when the income of individuals and the corporate entities are channeled through the banking and the finance company system, those money as balances recorded in their individual accounts helps the economy to manage the money flow rather than currency notes and coins kept at home. So when the money flow is carried out through the institutions, individuals and the corporate entities do the expenses also through the spending through the bank accounts that they hold. So the residual savings remain in the accounts, and that promotes the savings, total savings saved with the banks and finance companies and other financial institutions, which helps ready available savings base to the economic development. In other words, on lend to the people who do enterprises, who do manufacture goods and services, and therefore those money or savings are utilized in the positive, constructive economic activities. So please remember this formula: income minus expenses equals savings. People save now for future consumption. Now, those who have excess income or expenses, they do save now in the form of fixed deposits or in savings accounts or investment in the share market or any other, or buying property or anything, the economic activity. And then with a view to utilize those excess of income or expenses called savings for future consumption. Now, this rate of savings can be measured in each and every economy. A Sri Lankan savings rate, the pool of funds, saved money as a ratio is only in the region of 18 to 22%. Maximum was 22%, I think. But a smaller economy, a smaller geographical location like Singapore, but bigger economy right now than multiple size of Sri Lanka, their savings rate is in the region of about 45%. So it is interesting for someone to do a research. The savings base of developed economies is very high, in excess of 40s, whereas savings base of developing countries are low, 15, 20, 21, 22, or less than 25%. Because the savings of our economy, that is income or expenses in an economy, is very material or important for the economic development in a country. As you can very well envisage, even if your individual personal finances are concerned, when you have income or expenses, when there is savings, you can do many things. You do engage in a lot of economic activities, including spending for your evening enjoyment or dinners out or whatever. That is all economic activity. Or else you would save money, excess money, to buy a vehicle, buy a house, or buy clothes, so which is part of economic activity. So people save now for future consumption. Accumulated savings are invested. Then another section of the economy, section of community, borrow savings now and pay capital plus interest with their future savings. Now, young guys like you all might want to buy a car on leasing facilities or a bank loan, or buy a house and property, showing the lending institutions that you can pay with the excess of income or expenses, savings. for a number of years. But what are you doing? You are bringing forward your future savings to present consumption. So likewise, the entrepreneurs who do manufacture goods and services also do the same thing. They borrow money, working capital, or whatever the production costs. They use the savings of those people who have saved money with the banks or the finance companies, and then repay the borrowed money with interest, with the production and finished items, finished goods being sold, and then sale process obtained. So as the economic activity grow, savings increase. As economic activity grow, savings base increase. When there is less economic activity, now good comparison is like Sri Lanka economy comparatively very less economic activities compared to Singapore. Singapore economic activities are huge. So therefore, their savings base also increased tremendously. With each economic activity, there will be excess of income or expenses. So the savings accrue, savings base increase with increased economic activities. So these savings are vital for the economic development or investment for today, tomorrow, for future production of goods and services and economic activities. Now, where would these savings flow? To the financial intermediaries, licensed commercial banks, licensed specialized banks, registered finance companies are also known as deposit-taking institutions, and they are monitored and regulated by the Central Bank of Sri Lanka under the powers vested in them under the Monetary Law Act of 1949. Central Bank, the Director Bank Supervision is empowered to issue directions and regulations and supervise these LCBs and LSBs and then RFCs. Director Non-Bank Supervision Department is responsible to supervise the RFCs or registered finance companies. There are about 40 odd finance companies, and there are about 9 licensed specialized banks, including NSB and State Mortgage and Investment Bank. And there are about 24 licensed commercial banks, excluding the ICICI and the Axis Bank, who left Sri Lanka, closed up and then went back. But Bank of China came in. So therefore, we have about 24 licensed commercial banks. And the primary dealers, 13 or 15 of them, are supervised again by the Director Non-Bank Supervision Department and the Public Debt Department jointly. So the Central Bank of Sri Lanka is one of the regulators created and authorized by the statute passed by the Parliament. Then we have a second financial regulator called Securities and Exchange Commission, who is responsible to regulate the unit trust and the stockbrokers and the Colombo Stock Exchange. That is, again, there is a difference where the investments are attracted by these unit trust managed funds and the stockbrokers and the Colombo Stock Exchange. So there's a flare of investment, buying and selling with a profit motive. In the first case, Central Bank of Sri Lanka regulated deposit-taking institutions, LCBs, LSBs, and registered finance companies. They are merely accept deposit, So therefore, the responsibility of the central bank is to safeguard the depositor. But the SEC has the responsibility of safeguarding the investor who invests in the Colombo Stock Exchange or who invests in unit trust or in managed funds. Because there's a difference where the investors by nature are willing to accept a profit as well as a loss, as the case may be, as it comes. But in the case of depositing institutions, they will always give back or repay the deposits in total, the capital protected, and also pay back an interest agreed upon at the outset. So this is the difference between the central bank and the SEC. We have a third regulator in Sri Lanka, the third financial regulator called Insurance Regulatory Commission of Sri Lanka. Insurance Regulatory Commission of Sri Lanka. This is since of the year 2000, I think. Before that, we had Insurance Ombudsman, and again, it was converted to Insurance Board of Sri Lanka. Now we have Insurance Regulatory Commission of Sri Lanka. So their duty is to protect and safeguard the insurance policy holders. There are about 22 insurance companies in Sri Lanka. So those insurance companies absorb the risk of the general public, the economic activities, and risk of lives in the case of life insurance, risk of accidents and damages in the case of motor insurance, and the property insurance, and business insurance, and various other kinds of insurance they deal with. And the Insurance Regulatory Commission of Sri Lanka regulates the insurance companies with regard to the insurance policies that they are sold to the insurance policy holders. This again is to improve and propel the economic activity, because any businessman or production concern or even the life of insured, the risk is taken over by the insurance companies when it comes to economic activities. So the responsibilities of the financial intermediaries, now all these institutions are called financial intermediaries in the Sri Lankan context. I must admit and then share with you that the Sri Lankan structure of financial intermediaries is very lean and maybe underdeveloped. There are many more types of financial intermediaries in developed financial markets. We must aspire to that stage as soon as possible. But for the moment, these are the type of financial intermediaries that we have in Sri Lanka. And their responsibilities are to safeguard the depositor in the case of central bank, and in the case of SEC, safeguard the investor. If anyone wants to, please write it down in your notebooks. SEC will safeguard the investors and the shareholders. And also, they must ensure the best interests of the depositors and shareholders when it comes to Central Bank of Sri Lanka. And SEC must ensure the best interests of the investors and the shareholders. Then again, another responsibility is the optimum allocation of resources. This has a wide meaning. Now, the savings base shared as deposit by these institutions and investment by these institutions and insurance premium by these institutions is the net total of savings base. Now, this savings base has to be allocated in the best possible manner to achieve the development targets. That's what it means by optimum allocation of resources. Now, the so-called deposits accepted by the banks and finance companies, particularly, should not be allocated to one person, one company, group of companies, or particular geographical area. The savings base, that particular resource should serve the entire 22 million population in Sri Lanka. Now, with the modern day communication development, development in the telecom and communication in the industry, it is not only the 22 million population in Sri Lanka, but the entire global population. The entire world has become one economy, more or less. Only difference with the currencies that different currencies they used. Sorry. Or different types of economic activities in different parts of the world. Otherwise, the world economy has been brought closer due to the development of technology and the telecommunication industry, such as the computer systems and the payment and settlement systems. So this has a big meaning where optimal allocation of resources, the savings base shouldn't be kept for the benefit of only a group of people or one town or one village or one region only. It is true that in Sri Lanka, particularly, the empirical studies done has revealed that the rural population, they save with the banking institutions and the finance companies more, and their tendency to obtain loans or borrow money from these institutions is very less. In other words, all the banking institutions who run, or finance companies who run rural branches might confirm that they do have more deposits than their loan book or loans and advances. But quite opposite, the urban bank branches and the branches of finance companies will confirm that they entertain more loans and advances, and then they accept less deposits. So this is an anomaly we must see in the process of financial inclusion, that the rural folks also do obtain the benefits of the financial resources of savings as by way of loans and advances and develop themselves. There are barriers to achieve this optimum resource allocation, where most of the rural folks, their property titles are sometimes for the lending institutions like banks and finance companies, they want the clear ownership title for the land and buildings or the fixed income, fixed properties, fixed properties, so that they can keep them as mortgaged or collateral to borrow money. But that aspect has been very weak in the rural areas, which has been one reason. And the next reason would have been the enterprising abilities or skills of entrepreneurs in the rural areas may not match the skills of the entrepreneurs in the urban areas. So therefore, savings fund pool distribution to the rural areas had been not so good compared to the urban areas. So again, banks are custodians of the public funds. Banks do accept the deposit from the savers and they become custodians of the public funds, the savings base. The banks meaning including finance companies. Then the banks as providers of finance, those deposits accepted, the banks and finance companies must lend to make a interest income. So therefore, providers of finance. And the other part is that banks and finance companies should also act as the financial advisors to each and every customer who walks in, or each and every customer these banks and finance visit. They must be in a position to give the best of financial advice after studying and analyzing their particular financial scenario individually. They should be in a position to recommend the best financial product, financial package to them, saying that if any bank or finance company recommends a temporary overdraft or permanent overdraft for someone to buy a vehicle or a house, it is not a suitable facility. It should be a mortgage, it should be a term loan, and first, after analyzing the income sources of that concern or the company or the entity, business enterprise, only need to recommend the financial products, lending products that they have in their shelves to serve those communities. So now we just had an introduction to the economic activities and the savings base of the financial intermediaries. Now I'm trying to show you some latest figures of these banking institutions published in the mass media for the first quarter 2021. Banks deliver robust profits. Now this, I have not indicated the Bank of Ceylon and People's Bank here because they are, one thing, they have been the government institutions. Second thing, their financial figures have not been ready so far. But we know that Bank of Ceylon particularly had made enormous profits, more than all of these, but their figures are not finalized. Just look at these figures. I have also the figures for the finance companies. This is, of course, for the second quarter 2021. And for the finance companies, I have the return on equity, the profit after tax divided by the equity base. See the figures. Now let's get back to our sensible mode. What this period since of December 2019, we were experiencing a bad pandemic, COVID-19. And we know that most of the individuals and families and the other economic entities, small businesses, suffered their income. The income was lowered, the standard of living and the consumption was lowered. But at the same time, these financial intermediaries, the profit figures looks rosy. isn't it? They have made enormous amount of profits. One thing we learn in the asset and liability management is that when the fund or pool of fund managed by someone is very large, they can turn it around and make enormous amount of profits. As you all may confirm to me, being in the financial service industry right in the middle, that a fraction of interest rate, a fraction of exchange rate difference makes a huge margin when the amount, capital amount is large. Shall we say 5 pips on $100,000 and 5 pips on $1 million, or 5 pips on $100 million is huge, isn't it? So that's how these guys have been able to record this large magnitude of profits. And the other thing, when we do our studies and then when we engage in our learning process, we must understand that when we are in one of the same economy, now just imagine the shareholders and the board of directors and the senior management individuals on these institutions are also general public. Now, if the total savings base of the country taken in as deposits by these banks and finance companies, if they are able to make such a magnitude of large profits, whereas the other individual community economic stakeholders are suffering, sometimes hand-to-mouth existence, and some poor communities striving for their daily meals as well. It is very heartening to know, heartening to tell these guys that they must be not, they should not be sticking to the same old tariffs, the charges, high interest rates, high exchange rates, margins, commissions, fees. Instead, they must revise those lower or downward and allow the other community, other individual entrepreneur, citizen who earn a meager income to avail the services of these banks and finance companies and then share these excessive profits with them. If that had happened, it would have been more justifiable, more sensible. But however, these guys had not been able to share such high tariffs, high income generated through high tariffs with the other economic participants. And if that had happened, if that had been shared equitably, sometimes our economic growth, everybody in the economy would have been much more happier. And then the economic activities at large would have been multiples of 10 times by now. So this is where the regulators, the political authority or the sovereign authority should bear the responsibility in guiding this type of financial intermediaries to fix their interest rates, exchange rates, fees, and commissions in a fair and positive manner. then only the economy develops. In fairness to these institutions, I must also say that they have employed a huge amount of capital base to be in business. Just imagine the capital base of these commercial bank agent, Sampath Bank, NDB, and these guys. In couple of several billions of rupees is the capital. When you say 5% of that capital, sometimes this might justify, because the treasury bills also sometimes the treasury bills also the weighted average rates are also 5 or 6%. However, we live in an economy, in a country with other stakeholders, other individual customers, income earners, and then whatever the financial resource must be shared equitably. And then, whilst in hands of the poor guys to come up in their life through economic prosperity, that will convert into more economic activities, and the shareholders and the board of directors and the senior managers of these institutions also will be able to enjoy the fruits of higher living standards in the entire economy. So therefore, this is the fine tuning that should happen to the economy, and should be shared with each and every section of the economy. Now let's look a little deep into these figures. Now these financial intermediaries accept deposits by your savings deposits or current account deposits and fixed deposits. For current accounts balances, they won't pay interest, but savings accounts, they pay lower interest, but the fixed deposits, they pay little higher interest rate. And that constitutes the deposit book or the liability side of the balance sheet of these institutions. And the deposits attracted in that manner by these institutions are in turn on lend to the public or the enterprises in the same community at a higher rate. Now let's look at the current practical interest rates. Savings rate, savings accounts might be paid about 3% or 3.5% interest. It is not paid interest. Fixed deposits 1 year sometimes at 5.5% or 6% or in some cases 7.5%. But for the loans and advances, these institutions charge the customer who borrow money from them, maybe lowest can be about 7%, 6%, 8%, 9%, 10%, 11 or 12%. Thereby, if we take an average of 9% minus savings rate of 3.5%, they have 9 minus 3.5%, they have 5.5% margin. So that aspect has to be reviewed, or the regulator must guide these institutions where to fix this net interest margin or net interest income, NII or NIM. will help the flow of funds or savings to the poor community or the income groups. One other aspect that related to our topic, treasury management, stemming out of this study is that if you take the total deposit base of individual institutions and apply the interest spread 9% minus 3.5% or 9% minus 5% or something, or some weighted average or deposit book, it will come to only about 20-30% of these total profit figures. What I'm saying is, in any of these banking institutions or finance company, if you take the total deposit base and the total loan book and then apply that interest rate difference of 9% minus 3.5%, it might be about less than 50% of these profit figures. Then how come these guys got this balanced profit? It is because the treasury management, the large pool of funds by way of savings deposit and current account deposit and fixed deposit acquired, used in a professional manner to ride the yield curve or to the changing interest rate levels of the yield curve. You all know it's a public secret that when the interest rates were in the region of 10, 12, 13, 14% about 18 months ago, now the interest rate come down to about 5%, 6%, and 7%. So it's about 50% reduction of, it is about half of the interest rates that prevailed about 18 months ago. When the interest rate curve or the yield curve is not sloping like that, what does this banks and finance companies do? They already have their deposit base, they already have their loan base. At a declining interest rate curve, they reprice the deposit book, savings base, and the fixed deposit in the first opportunity they get to a lower rate, market rate. But repricing or revising the lending rates, they will postpone it to the last moment that they could. So that effectively the interest spread will widen time duration that the interest rate curve declines on the total deposit base and the total advance base. So the net interest income or net interest margin or the spread that they earn is enhanced to these institutions, these banks and finance companies during that period. At the same time, if you think of a era where the interest rates are increasing, this institution will, first of all, reprice the asset side or loans very quickly in the first opportunity they get. But the interest expenses on the deposit base will be revised at the last moment they could afford to postpone, thereby save interest expenses on a rising interest rate curve. So therefore, there again, they enhance the net interest margin or the interest spread. So these are the tactics that they do on a large pool of funds by way of accepted deposits. When they play this game, their profits enhance in mega amounts. The net change, net increase compared to the previous first quarter to 2020 is so much, 78% in the case of commercial bank, 90% in the case of Sampath Bank, 92% in the case of NDB, 88% in the case of NTB. So such magnitude of large increases or profit change, positive side is seen in this era of interest rate changes. Plus, they employ the treasury personnel to manage or manipulate these large pool of funds and invest them in treasury bills, treasury bonds, or foreign currency investments, and try to maximize the profits every time. And also they will try to minimize the losses all the time. So this is where the treasury function, treasury role comes in. And they are able to record such magnitude of high profits when the COVID pandemic prevailed and the entire economy was suffering. Any idea, any comment by anyone? No idea, no comment. So up to now, we have just taken an introduction to the treasury activities, the management of the pool of funds by the deposit-taking institutions. From here onwards, we'll be dipping into the activities of the treasuries and then trying to look at how does this skillful guys make this profitability possible. I would like someone to just make a comment or ask question so that I know that everyone is listening and then everyone is in the same page that I am explaining with. Any question, please?
Not from me, sir.
Not from you. Okay. When you had understood everything very positively.
Generally the case, sir.
Okay. But do you agree with the comment that I made? The financial intermediaries should at least share some of their profits with their customers so that everybody is in the same use of.
So sharing profits with customers, I mean, I guess first of all the business has to be sustainable. So beyond that, I already believe that the discounting also to an extent is something of that sort, right?
Not only that, my dear, now when it comes to when we know that the banking financial intermediaries are such profitable institutions and they are dependent on these customers, because of the customers only they made their money.
Yes.
And because the customers, they're making money, large quantum of money, it's true that they have spent a lot of capital to reap the benefit of the large profits. But however, my argument is that when they lower, as a practice, when they lower the profits, margins or tariffs or fees or commissions that they charge, their customers, the general public, will be attracted more to those institutions, and they will be compelled to do more activities, more transactions with them. Thereby, the economic activities will be developing in the economy.
So I think so. It's a very fine line between balancing the interest of the the shareholders as well as the customers, because that from one side they have to ensure that the shareholders or the stakeholders get a appropriate return for their investment, and on the
True
other
enough.
side
True enough.
keep the clients interested without charging excess costs on them.
Now, true enough. Now, who are the shareholders? They are also part and parcel of the society, right? Individuals in the society.
Yes, my view is that obviously shareholders would invest in any business with with the expectation that they get uh, a fairly reasonable return. So, if the organization tries to squeeze the costs or the charges or the revenue streams too much, that might tilt the balance the other way.
Yes. Now, when you compare the banking institutions, the finance companies, institutions with other entities, other business like supermarkets or any other trading organization, the banking business or the finance business has been more profitable than any other business industry, isn't it?
Yeah, agree, sir. I mean, in terms of economic cycle or business cycle, it can weather most conditions. I agree, but at the same time, how do I say? My point of view is that the management needs to be able to balance a very fine line between shareholder interest and public interest. Obviously,
That is true. That is the enterprise skills that they should possess. Of course, guided by the regulator, guided by the
yes,
guided by the regulator, they should be, because regulators, the sovereign authority, the political authority, the regulator, the shareholders of banks and finance companies and other institutions, all are part and parcel of the same economy, same society. So
agreed,
it is a matter that everybody get together and then fine tune, as you said, fine tune the profit margins or the commissions or the charges that they levy the other party or customer, and then enable more economic activities, and then help even the poor communities to lift their living standards, right? If that happens, a all-win situation. By nature of the business, banking and finance company businesses are profitable. That amount of profit, to show the higher dividends or higher profitability for the shareholders,
yeah,
doesn't hold valid when the other section of the community is in a hand-to-mouth existence
agreed,
spray.
agreed,
This is where the regulators' skills and the management skills of these institutions, plus how to share the excess profits, and then get the other low income and medium income guys to do more business, and then create more economic activities. And with the volumes, they can this institution might be able to even record more profits than ever, right? They should aim at the economics of scale by encouraging more economic activities. All right, thank you for the comment. Anything else?
No, sir.
Thank you. This type of discussion would help everyone to refresh their minds. That's the idea. So economic activities of Treasury. So you know the importance of Treasury in managing and then recording such profits in the financial service industry, in the financial service intermediaries. Ensure adequate optimum funds for the business. For the business activity, the Treasury must ensure adequate funds, starting from this very old point of savings deposits and current account depositors may want to withdraw their money on demand. By way of experience and the practice, they know for each day, each business day, how much monies are withdrawn by the savings deposit customers and then current account deposit customers. So empirically, they have been withdrawing something about 5% of the total deposit base on a daily basis. But as the days goes by, new deposits are also attracted. So this volume of 5% of deposit base sometimes are withdrawn daily, but there can be increased deposits coming in as well. If the first month any particular institution had 100 billion deposit base, by the next month it could be 101 billion. By the month after, it can be about 102 billion. But still, they on a daily basis, they might encounter about 5% of the total deposit base withdrawals taking place by the needy customers who have earlier deposited their money, savings, with this financial service industry, banks and finance companies. So as we discussed, the collection and the attraction of the public savings as deposit helps the economy to develop, because they are able to pool a large quantity of funds and lend the same funds to a needy sections, entrepreneurs, manufacturers, for the production of their goods and services, or the consumption of buying a car or buying a house or whatever. So when that happens, economic activity progress. So Treasury's one of the main business is allocation of optimum amount of funds for the business, particularly keeping liquid cash on the strong room or the vault to enable next day's withdrawal to take place or fund the withdrawals demanded by the depositors up to about 5% of the total deposit base. But in case if there is a reputation problem with the bank or on the run on the bank, that 5% might increase to about 50% or 100% sometimes. But where we saw some experiences, particularly in Sri Lanka and then almost all the time in the rest of the world, where when the banking and financial institutions are not well managed to maintain their reputation, new deposits will not be attracted, and then existing deposits may be withdrawn fast, and plus there can be run on the banks, queuing. Depositor might queue up in front of the counters to withdraw their money when the reputation is damaged. So therefore, compliance to the regulations by the regulator and the normal ethics, public ethics, including the attire and then the language and the behavior of this financial intermediary employees is material to manage or increase the level of deposits and then meet all the liabilities or obligations as the time goes on. So optimum funds for business activities, including withdrawals of savings and current account deposits, and then payment for imports, exports, proceeds payment to the customers, outward remittances, inward remittances by customers. The fund base should be made available by the Treasury personnel in the quantity required and on a timely basis. You know, the value dates are very important. When we take the total deposit base of a bank or finance company, only about 60, 70 or 75, 80% of the total deposit base is used or utilized to on lend to other customers who need the funds. And the balance, about 15, 20% is invested in investment of maybe land and building for offices and other infrastructure facilities. And then also another 10 or 15% is used by the Treasury to maintain the vault cash and other investment in Treasury bills and bonds or stock market shares and whatever the marketable securities. So when that happens, the regulator, in the pursuit of distributing the savings pool of funds collected by the deposit-taking institutions to the important and necessary industries like housing, agriculture, and so on and so forth, they issue directions to these institutions, deposit-taking institutions, to at least lend 10% to housing, at least lend 10% to agriculture. So those become mandatory requirement. And if any bank or finance company has mobilized 100 billion deposits, 10 billion must go to, the ratios differ time to time. 10 billion will go to housing, 10 billion will go to agriculture, the basic, important, necessary industries in the economy. So whilst maintaining those benchmark fund allocations, lendings, the Treasury would propose the pricing of all these assets and liabilities as well, particularly savings to be savings deposits to be paid interest rate at 3 or 3.5%. Current account, of course, not paid interest in Sri Lanka. Then fixed deposit 1 year to be paid at 5.5%, 2 years to be paid at 6%, 5 years to be paid at 7%, like that. All those initial suggestions, proposals are drafted by the Treasury for the approval of the higher level committees like Asset and Liability Management Committee or ALCO. Then the lending excess funds to optimum rate to short-term money market also happens. Now, likewise, lending products are also priced on the proposals by the Treasury personnel going by the market interest rates. For personal loans, X amount of rate to be charged. For credit cards, say 16-17% interest rate to be charged. For leasing facilities, say 12-13% to be charged. Then mortgage, housing mortgage loans, 7-9% to be charged. All those proposals are brought in by the Treasury for approval by the Asset and Liability Management Committee, and then made possible for practical implementation. So final amount of quantum of money left for the management by the Treasury team, lending excess funds at optimum rate to the short-term money market, called money market, or investment in treasury bill, treasury bonds, or investment in the share market, or investment in the gold market, happens as the analysis of feasibility suggests to the Treasury personnel, and that convenience of easy application of funds. Then borrowing funds to cover deficits to meet statutory, regulatory, and management requirements. As the fund base is managed on a day-to-day, there can be days where the urgent fund withdrawals by the customers and then urgent payments out by customers or for the bank needs happens, and there can be borrowing needs arising, and to cover in the cash flows, deficits to be covered. So therefore, the Treasury team must act swiftly, act quickly, and will have to arrange funds to meet such a deficit, maybe using the already invested treasury bill base, treasury bond base, or share market investments, or any other liquid fund form investments in the first place. If not, they may resort to borrow in the market, in the call money market, or sometimes they can be selling the foreign currencies to generate rupees and then arranging swaps to cover the position as well. So invest in money market deficits to meet statutory regulatory management requirements. And then the cash management. All cash management and then other cash management exercises or functions are also to be meticulously planned, because vault cash management involves the security, insurance cover, transport, cash transport cover expenses as well. So these are high cost actions and would attract more expenses if not managed properly. Then trading in money market and foreign exchange and on permitted derivatives markets is another activity of Treasury. So the objectives of the Treasury activities: minimize exposure to adverse interest rate movements, minimize exposure to adverse exchange rate movements, minimize cost of funds, and to maximize return on investments. These are broadly identified objectives of a Treasury. This is how those banking institutions and the finance companies are able to record mega profits by driving all the focus and the activities to meet these objectives. Then monitor, evaluate, and report on treasury performance is another objective and also become an activity to the senior management committees, and then also to the regulator. Optimize return on market risks and related activities. Structuring and arranging short, medium, and long-term funding at the lowest cost. Optimizing flexibility and then spread of debt maturity. Optimizing flexibility and spread of debt maturity, again, is a asset and liability management exercise very well practiced in the treasuries of these financial institutions. Borrowing funds and transacting of risk management instruments within an environment of control and compliance, within approved risk parameters to protect financial assets and minimize costs. Borrowing funds and transacting risk management instruments, the adhering to those limits imposed, loss limits, counterparty limits, and settlement risk measures to be implemented to the activities of Treasury. Maintaining liquidity levels and managing cash flows to meet known and reasonable unforeseen funding requirements. We explained that a little while ago. But the maintenance of liquidity levels is a prime concern of the Treasury team, and they need to focus on this activity every time that they are engaged at the official duties at the Treasury of a financial institution. Ensure all financial statutory requirements are maintained at optimum level. Statutory requirement like liquidity measures, liquidity ratios to be maintained, then statutory reserve ratio to be maintained, and volumes of certain portfolios like treasury bill, treasury bonds, easily encashable financial liquid instruments, a portfolio level limits must be maintained. Ensure implementation of internal controls. We'll be discussing more internal controls as we progress on the slideshow. Basically, the activities of one person is overseen by another one person or two people, so that to avoid human errors plus any intentional errors that might be committed, something like frauds. So the internal controls are really important in treasury management. Ensure that board of directors, management, relevant staff are kept informed of latest development in treasury, markets, products, methodologies, controls, compliance requirements, and accounting treatments. So basically, the compliance requirements of the regulations, we can divide them into two parts. One is the internal controls where the board of directors and the senior management issue controls, limits to be maintained, and compliance to those requirements are a must. Then also you get set of other regulations, rules imposed by the outside regulators like Central Bank of Sri Lanka, SEC, or Insurance Regulatory Commission of Sri Lanka. Those also must be complied with to safeguard the interest of the depositors and the shareholders. And then also institutions like Chartered Accountants Institution also issue guidelines on accounting treatments like IAS 39, IFRS 9, and each and every financial institution should adhere to and comply with those controls and regulations as they come, and then to be of service to the community. Now, a good example is that due to the COVID-19 pandemic, most of these banks and finance companies are being requested to implement a debt moratorium to the people who have borrowed money on leasing and various other loan installments for working capital requirements. They have been asked to postpone recovery of loans plus interest for a certain time period. So that will attract a lot of loss of revenue to these institutions and then losses to the P&L. Because during that period, this institution must pay the interest for the depositors. There is no moratorium on those, but the moratorium request by the regulator is on the loans and advances for the affected communities who have borrowed money from these institutions. All right. We're coming to a certain juncture where yes, any comment? Hello? Please feel free to speak up. The Nostro-Vostro accounts are critical arrangements that these financial intermediaries have to facilitate the conduct of their business activities. Nostro account is our account with them, and Vostro account is their account with us. Now, these two types of accounts facilitate fund transfers between the institutions for their own account as well as on behalf of the customers as and when they instruct. However, when it comes to foreign currency Nostro accounts and Vostro accounts maintained by the financial institutions in other jurisdictions, other countries, the exchange regulations come into play, are implemented, where the regulatory authority would not permit overdrawing of Nostro accounts. In other words, Nostro account balance should not go down below zero because it might attract overdraft interest at very high exorbitant rate because of the fact that we are in a different jurisdiction, different laws, and the recovery of money or the amount of overdraft sometimes may not be possible. So therefore, the result is that high and exorbitant interest rate charged on the such overdrafts. Then when it comes to excess funds left, they won't pay interest on the excess fund balances. So therefore, a direct loss of income, loss of interest for the amount of funds that is kept in those nostro accounts. So therefore, direct impact on the P&L. Therefore, all the transactions that are routed through these nostro accounts has to be funded timely, not very much earlier and not very much late. The funding should be meticulously planned time-wise. If not, the performance, the P&L will suffer by way of excess interest payments in the case of overdraft and loss of interest income in the case of excess balances maintained. For funding, there should be a mechanism to ascertain the required amount of funds in each currency in each account, because nostro accounts are maintained in different countries where the legal currency tender is possible, because of the fact that particularly the international trade and the international remittances happens in those currencies from those countries. So ascertaining the required amount of funds to meet those payments out, and when the funds are coming in, the information that the amount of the funds, the quantity of the funds, currency, and the time funds are received is also important for the treasury dealers to utilize such funds quickly without loss of interest. Then ascertaining time funds are required and the value date is also a material importance. And then again, transferring excess funds or selling foreign currency for LKR also happens. To ascertain these fund flows, both inward and outward, and in each currency, treasury personnel must be making some arrangements to obtain information from various units of the bank or finance company when the funds commitment arises as quickly as possible. Example, if there is an import customer requiring to pay $100,000 for import of machinery, the time and the date money is required in the nostro account to meet the $100,000 payment should be informed to the treasury dealers without delay. As soon as the information of the transaction is available, such information must be shared with the treasury. Similarly, receipt of funds for export proceeds also must be notified to the treasury dealers. So good thing is that modern core banking systems, computer systems, facilitate updating of the cash flow, respect to cash flow in each currency And for one currency, sometimes there can be 2-3 cash flow, 2-3 no-stock accounts or stock accounts. The relevant cash flow is updated through the core banking system and the ancillary systems like trade finance, remittances, credit cards, and other business units. Real time, as and when the transaction is input to the core banking system, the programs are enabled to update the respective cash flows in the currency that is needed and in the particular nostro account, the currency is needed. So therefore, modern core banking systems facilitate such information to be flowed to the treasury dealers quickly. So it's a matter of obtaining a confirmation sometimes, or if the transactions after execution, if there is a deviation or amendment, or if there's a cancellation, then that fact should be communicated fast to the treasury front office guys who are managing the balances in the nostro accounts. So in managing the nostro accounts and facilitating inward and outward fund transfers, this financial telecommunication mechanism of SWIFT, Society for Worldwide Interbank Financial Telecommunication, has come to the forefront with indispensable, most of the time, indispensable importance. Usage of SWIFT message by the banking institutions in the current era is very much required. Fund transfers out for customers, SWIFT empty particular message type 103 are used, and on behalf of the bank or institution own account, SWIFT empty 202 is used. This is to say, those of you who do not know much about SWIFT, Society for Worldwide Interbank Financial Telecommunication is based in Belgium, and this started somewhere in the 1960s as a cooperative society, meaning the members who seek the membership of SWIFT are the owners of this SWIFT Institute. It's a multinational organization now, but ironically, it had not borrowed a single cent from any banking institution, debt-free, because it is managed by the members. Of course, there's a dedicated staff involved in day-to-day management, but SWIFT members are the owners of this society or telecommunication platform, and they are required to undergo certain certification before becoming a member. That member is similar to listing shares of a company at the stock exchange. Because of the importance of the system, financial telecommunication system, the members must take utmost care in securing the encryption and the system security standards to prevent unauthorized people getting into the system. So therefore, all the members who become SWIFT members are supposed to go through certain criteria of standardized security implementation and enhancements. We'll discuss in a while. So as appropriate for this point in time, the Swift messages are categorized into about 10 types of message types. 100 series, 200 series, 300 series, 400 series, 500 series, 600 series, and 700 series. So Swift MT 100 series, starting from 100 to 199, are used to communicate the financial telecommunication messages of customers. Swift MT 200 to 299 message types are used to communicate inter-institution or inter-bank fund transfers or communications. So likewise, the 500 series are used to communicate the securities related fund transfers and security transfers, like treasury bills and treasury bonds. Then 700 series are used to communicate imports and exports or trade finance related message communication. So similarly, 300 series are used for foreign exchange transaction messages to be communicated. So in the case of a customer instructed fund transfer remittance, the bank will use Swift MT 103 to be paid to the beneficiary customer to the account of his bank, wherever it's located in any corner of the world. So in that also it is standardized and formatted so that the particular message is made machine readable and could be processed without a human being involved or manual intervention. How it is done is that Swift MT 103 particularly is identified as a customer intended transfer. Funds to be credited to a customer, particular customer's account at a particular bank or financial institution. And such transfers, each field of that Swift MT 103 message, starting from the currency code, currency amount, name of the beneficiary customer, name of the beneficiary bank, account number of the beneficiary in that particular bank, and if there is an intermediary bank through which the funds should be transferred, the details of that, and the details of the remitter and the reason for remittance is indicated in the respective fields. So as soon as the Swift MT 103 is received by the recipient bank, their Swift server knows that it is a customer transfer. And the server will look for the currency code and currency amount and the beneficiary customer account number and the name. And if everything is matched, it will process the credit to the customer account as soon as it receives and the processing run is done. So it's a matter of few seconds, it will credit the beneficiary customer account. Similarly, interbank transfers again will indicate Swift MT 202 message type And on receipt of the message, the SWIFT server of the recipient bank will know that these funds are coming from a counterparty bank and intended for the particular bank, and will route the proceeds of the funds, the currency code and currency amount, to the respective account and inform with the intimation to the respective department that the funds are received for the sale of foreign exchange, funds are received for the sale of treasury bill, and so on and so forth. So this type of arrangement is very useful. This type of arrangement is very useful to efficient processing of the transactions and to avoid any malpractices or human errors. These arrangements come in handy when a particular banking institution would process thousands and thousands of messages on a particular business day. Otherwise, they may have to employ hundreds of people to process such messages and check accuracy. But because of the efficacy of the SWIFT financial telecommunication system and the arrangement of the standardizing, it has been made so much efficiency and friendly and manual intervention free system. Okay, now we are stepping into SWIFT MT 500 series, treasury bonds. I think we should discuss that part little in length on the next day. As I told you, tomorrow we will not be having the class. We will have the class on day after tomorrow or Thursday, so that we'll have more time to elaborate and discuss on the 500 series messages, related fund transfers, and many more. So, any questions up to now? I'm waiting to hear some voice. One might wonder why all these details in treasury management for the certificate course in money brokering. It is necessary because you serve the banking institutions and the primary dealers who should be practicing exactly this. And if any such institutions or clients of yours miss the usage of certain aspect, then you can be of some advice to such clients. And then when you discuss the real business that they do, you tend to win more business. They will know that these guys are aware of our business as well. So let's engage them more. So therefore, the content of this type of information in your course was made possible for you to have a better understanding of the functioning of banking systems and the primary data systems, the RTJ system and the scriptless security settlement systems, and related software and hardware, plus the business mechanisms. Okay, so since there are no questions or comments, we shall stop for today. And I wish you all good night for the day.